Hello everyone, and welcome to our Digital Finance Services webinar, What to Do and When to Do It. We are very excited to have this webinar today with an expert in DFS like Andrew Lake. To all of you who are joining CapPlus webinar for the first time, we want to welcome you and we hope that you join us in the future. We have two upcoming webinars. One of them is going to be in November and the other one in December. Before giving the floor to Andrew, I want to introduce him to all of you. Andrew Lake has 19 years of experience in digital financial services and is CapPlus Digital Financial Services expert, positioning CapPlus in the field of digital as an adjacent vertical market to low-cost schools. Prior to this, he was a global digital financial service specialist with the IFC. And as such, he has guided many banks, non-financial institutions, and microfinance institutions, as well as fintech companies in the development, improvement, and implementation of their digital strategies. Andrew has been working all over the world in Eastern Europe, Latin America, Africa, Middle East, and Southeast Asia. Prior to joining the IFC, Andrew started and managed two full commercial mobile banking operations, one in South Africa and one in Bahrain. Andrew also took both organizations from the concept to the end of their first year of trading. So now it's time for Andrew to start his presentation. So Andrew, the floor is yours.
Great, thank you, Alkis, and welcome to all the people in the audience. As Alkis said, digital financial services is something I have been dabbling with working in for a long time, 19 heading towards 20 years. Yes, I think it's a very important development in financial services, and it holds the potential to fundamentally change the industry. In fact, it already is fundamentally changing the industry, something we'll cover a bit in this webinar. I'll take you through basically the contents of this webinar. We'll go through some definitions of digital financial services. The reason for this, I'm certain most people have a set of definitions in their mind, but it's just to get the nomenclature constant in everybody's mind, so that we can all basically, we're using the same language as one another. Then we'll talk about why digital financial services are important to financial institutions at this point in the development of the industry. We'll speak a bit about operating models and partnerships, and then, as Alkis said, we have the Q&A. So really, what is digital all about? Quite frankly, it is about using technology to sweat existing assets, existing capacity in the market already to deliver mind-blowing financial services to your customers. It's the digital bit, if you like, is more of a glue than the objective itself. It enables you to access existing infrastructure out there, for instance, mobile phones, people's shops, to turn those into points of delivery of your banking services to your customers. And you'll deliver a better product off a lower cost base. At the bottom there, I've included that little sentence, which is that this is both an opportunity and a threat. The opportunity, of course, and I'll unpack this later in the presentation, is the ability to drive down your operating costs and to service your customers more generally. The threat is that it has opened up the market to a whole host of new entrants and a whole host of new competitors, which we will need to countenance when in our day-to-day trading going forward. Digital and alternate delivery channels come together on this following plane. The digital component is all the digital bits and pieces. I know the font on this page is very small. Don't worry. David tells me he will be sharing a PDF version of this slide with everybody. So if you can't read the small font, don't worry. The digital component of digital and ADC is all the electronic bits and bobs that you can use for banking. By that, I'm referring to cards, I'm referring to point-of-sale devices, ATMs, mobile phones, call centers. Something that's not the thing that's not on the slide is effectively all the digital re-rating of credit, alternate lifestyle type rating. Those fall in the scope of what is known as digital financial services. Alternate delivery channels is using non-traditional banking channels to deliver banking services, such as using shops to open accounts and or do cash in, cash out activities on behalf of your institution in such a way as to enable you to have a larger footprint. So ADC and digital work together hand in hand to deliver access to existing infrastructure outside in the market. So what is digital typically used for? Quite frankly, you can use digital to entirely deliver your banking service. That has already emerged in the high-end economies. For instance, in the UK, you already have things like Atom Bank, and you have First Direct. First Direct was a subsidiary of HSBC, which has basically been trading for the better part of 20 years now. They're entirely branchless. They are entirely digital. A client's banking life is controlled completely off the internet and using card. Atom, in fact, was started by the same man who started First Direct, and it's effectively, although I'm sure they wouldn't want to hear me say this, it's effectively First Direct delivered to mobile phones, but it's the same thing. You have a digital front end on a device and a card. That is made possible in England because 90% of the transactions in England are non-cash, and cash is not king at all. The other thing is that the ATM infrastructure in England is well developed, and as is cashback at retail. So no bank need worry about issuing new infrastructure to handle cash, to provide a digital service within the UK. This, of course, is not true in the developing world, where cash is king. 80–90% of transactions are cash in the retail environment, and also your clients need access to cash. The ATM infrastructure isn't necessarily that well developed, and so cash is a hurdle in the delivery of digital banking, because we need to go from cash to digital to effect digital transactions, and then we need to be able to transfer back from digital into cash at a point. But having said that, the capacity of digital is to basically effectively run your bank. So on the right-hand side of the slide there, we're talking about savings, credit, insurance, all the normal asset type banking things. And on the left hand, all the transactional types, including retail purchases, payroll services, etc. Later in this presentation, I'll be taking you through an example of how digital completely revolutionized payroll in a school in Liberia, which basically just to highlight the potential of digital to open up new markets. So why is digital important? Why can't we just live and let live and continue to run our own lives as they are? The problem is that the market has changed completely. That little pink cake to the left of the yellow Pac-Man on the left is the banking current business. And across the world, it is under threat from telcos and retailers who are seeking to get bigger and bigger portions of it. Behind the telcos and the retailers, all those little green Pac-Men are what are known as the fintech startups. They are cherry picking specific parts of traditional financial services business, the more profitable ones, such as lending, such as credit vetting, such as brokerage, are being honed in as specific verticals by the fintechs, and the more profitable businesses are being migrated towards them, particularly in the more developed world. But in the developing world, this is going to be a strong player as well. And behind all of that, in terms of transition of the industry, we have the Apples, the Googles, the Google Pay, the Android Pays of the world coming in. These are what are called the over-the-top services, where, for instance, if I were to sign up today with Google, with Android Pay, because I have an Android device, I would effectively alias my HSBC credit card behind Google Pay or Android Pay, and I would walk around and I'd tap my phone. The value proposition to me as a customer to do that is that I don't have to carry my wallet anymore. The downside to me is that I probably get myself into trouble with my chargeback rights on the card, but that's not something that gets highlighted a lot when these products are being sold. Why would Google, or why would Google do such a thing? Well, what they're trying to do is they're trying to enter an industry by stealth, the same way they entered effectively the information market. People believe that they Google for answers. Well, Google is a search engine that links them to an underlying website which can answer a query about window frames or whatever I want to know about. People, the consumer market has lost context of the fact that Google are an overlay on top of a whole lot of websites, and that they are the linkage to multiple information sources. So too, if we alias my credit card into my Android Pay, I eventually start to lose brand affinity with HSBC and start to get a brand affinity with Android Pay. And in so doing, although all the financial work is done by HSBC in this example, my perception of who I actually bank with and who provides the service in each payment interaction actually becomes blurred. That little gray, returning to the picture on the screen, that little gray disc there with all the Pac-Men is the reality of the market today. And we have, as I say at the top of the blue block, multiple new entrants in the market. I believe that financial service institutions need to adapt their business models to take cognizance of this. It's a reality. It's not going away. If anything, it's going to get bigger and bigger, particularly with advances in technology such as data analytics, etc. That will fundamentally it is already fundamentally changing the way retail credit is extended. Alternate scoring based on customer behavior on their phones and on things like Facebook. Many people smile when they hear about this, because there are still going to be some notable mistakes made by lending on this basis. But I do believe that the trend is going to continue, and the basis on which we vet people will be honed to the point at which we'll be able to instantly vet people fairly accurately. These new products and channels entering the market are going to position the little Pac-Man squarely in our market, and we need to be ready for this. And finally, the last thing is that the market itself, the customers, the nature of the customers is changing. We've gone from the baby boomers to the Gen X, and now the millennials are becoming the next market. They have grown up on the internet. They have grown up with phones in the house. They expect their lives to be delivered to them across these devices. And if we're not on them, then the perception of the client is that of this new millennial market is that we don't exist. And therefore, I think it is fundamentally important to all institutions to have a very strong digital footprint, so that they are part of the future market. So how is this change taking place? It's taking place on a continuum from innovation to disruption, with doing new things, for want of a better word, somewhere in the middle. Innovation is effectively taking existing processes and making them better. And if I can illuminate that perhaps with an example of the credit card. Many, many years ago, if you were a merchant and accepted credit card, you would take an imprint of the card and you'd write a whole lot of information on a form, and the customer would sign it, and you'd mail that off to the bank, and the bank would eventually receive it, process it, and clear it. Now today, you pull the card through a terminal. The same information that you used to capture on the piece of paper is now captured electronically, and the authorization is issued in real time, and the funds settle that night. The process is not actually that different. What is different is the flow of the information and how it is done. That, to my mind, is innovation. It's made the product a lot more sophisticated and work a lot more quickly and a lot more effectively. But the truth is, it's the same process. Disruption, on the other end, is when somebody comes in and and produces a substitute product that effectively changes the way the existing market works. And the biggest disruption that is coming right now is going to be in the lending front. There's an example there of Jumo, which I will touch on later I will take you through Jumo in some detail in a few moments. They are effectively a non-bank financial institution lender who borrow on the wholesale market and lend in the retail market, but they do it in such a way that they have the potential to crowd out a lot of the banks and a lot of the MFIs. But more about that later. In the middle, we have people doing new things. So we have telcos entering banking in a big way, and they've got a very strong foothold in Africa, and they're starting to get a good foothold in it in Asia. There is no difference between the so-called mobile money account and a current account. They are holders of funds that allow the customer to effect electronic transactions over the funds. So if you're a purist, you would say there is nothing different between a current account and a mobile money account, except for perhaps one thing, that there is no checkbook, but checkbooks clearly are in runoff anyway. These new entrants, these people doing new things are currently probably the biggest impactors of change, certainly in Africa and Pakistan. It's shifting that way quite rapidly too. So it's going to be interesting. And a quote that was bounding around: it has to only be a matter of time before the sleeping giants of financial services rise up and disrupt the disruptors to defend themselves in their own market. So what is it that we can do with digital? What can digital do to our businesses if we decide to adopt it? Basically, there are 4 quadrants where we think that digital could fundamentally help your business. The first, the top right, the green one, is expansion. By that, we're referring to the ability to grow your business at non-linear growth rates because of quite different new target markets you can address. Because if you choose to rebrand yourself, as one bank did, I've got an example for you in a few moments, of a bank that effectively had its brand subsumed by a telco and presented as a telco offering, and in so doing delivered it became a single bank that was bigger than the entire banking sector in terms of number of customers at the time they started the product. You can use it to expand your geography, because it is a lot less expensive to expand geographically if you're using digital and alternate delivery channels, and therefore you can open up territories which might not otherwise be economically viable. And you, as I said before, you can possibly use secondary brands. Cost containment: digital is substantially cheaper than branch and manual workarounds. We did a lot of work on this while I was at the IFC and through CGAP, and we worked out that it costs approximately 15% of what it costs to do things manually, i.e. there's an 85% cost saving to be had going purely digital as opposed to going branches and paper. Customer service: because digital allows you to put your institution right in your customer's pocket and right wherever they happen to be, you cannot be more convenient in the financial services sector. So there's definitely advantage there. Defensive is something I've included for completeness, really. There are the larger established banks. Some of them are behaving possibly, you could argue that they're acting defensively. If I flip back to the previous slide, at the top there where I said banks are innovating their business model, Stanbic and Barclays, for instance, in Africa, are busy rolling mobile banking apps into their market. But why are they doing that? What's the strategy behind it? It's not a mass acquisition strategy. They're not changing market segments. They're not going down into poorer income categories. They are actually using it, I believe, in some ways as a defensive strategy against things like M-Pesa, where they effectively deliver a mobile banking service to their existing customers, which is linked to the existing customer's portfolio, and they just say, and basically the subtext is, guys, we've got it. You don't need to go there to get to the other guys to get it. And that effectively would be a defensive strategy to retain your own customer base. Key across the bottom, that red block: anybody entering digital financial services or alternative delivery channels needs to prioritize what it is that they're looking to achieve out of this business, because how you weight these various objectives changes substantially how you would be willing to start the business and what you would be willing to trade if you were going to go into a partnership to achieve any of the business objectives. So just to unpack what we mean by expansion by way of an example, M-Shwari is the savings and loan component behind M-Pesa in Kenya with Safaricom and M-Pesa. Unfortunately, it's very difficult to talk about digital without talking about the poster child of digital, which is, of course, M-Pesa. This is a strategic arrangement between CBA. CBA is the bank which underlines the transaction account, which is called M-Pesa, and they then came forward with a savings and loan product called M-Shwari, which they bolted onto the transactional product. Prior to the launch of M-Shwari, CBA, or in fact M-Pesa, CBA was a niche bank, a corporate bank with some 60,000 customers who effectively were small companies and the owners and senior management of those companies. Their objective in doing this was to make a splash and make significant growth into retail. Safaricom, which is a telco who own M-Pesa, wanted to add value to the M-Pesa product. They had at that stage about 18 million customers who were predominantly using it as a remittance tool and for small payments, but they weren't getting any traction. There was no lock-in of funds, and the clients were treating it almost as a utility, not as a partnership. So they wanted to add some gravitas to the product. They launched it in November 2012. If you look down the bottom right corner, you'll see the growth in active customer base. Basically, in 24 months, they went to 5.8 million borrowers and savers. Top right corner, the loan performance of the loan book is running at about 2% NPLs, which is very good by any manner of means. They charge approximately, last I looked, about 50% interest, although they call it service fees per annum, and they're running at NPLs of 2%. If you look at it from CBA's point of view, for the client to apply for a loan, he picks up his phone, he goes to the menu and he says, I would like a loan. Based on a mixture of alternate rating, which is based on his use of his phone, his repayment, his top-up behavior, as well as his M-Pesa behavior, which is effectively a rating of his transactional capacity, which is more in line with traditional rating models. That combined rating, combined with how much money he has in his savings account, sets the maximum that he would be granted. Assuming when he picks up his phone and asks for a loan that the sum requested is less than or equal to the maximum that they would be willing to lend to the customer, they simply grant the loan right there and then. And the funds are dispatched into the M-Pesa account, and they are disbursed via the agent network. So CBA as a lender has virtually zero cost involved in granting and distributing loans. So they are effectively in a position where at virtually zero cost, they can grant a loan. They're running at 2%. They have a reasonably compelling argument for the client not to renege on the loan, because they can do two things. They can foreclose on the savings account, and they also have the right to withdraw the phone number from the client, which would be quite detrimental to the client's future in the rest of his life. So that in a nutshell is M-Shwari. It's a very low cost operation, very high margin. It's what's not to like. I spoke earlier about Jumo as well. Jumo is a South African-based non-banking financial institution lender. They borrow in the wholesale market and lend in the retail market. Their go-to-market model is also via the mobile money operations around Africa, and the one that perhaps that's the most interesting to look at is what they did in Tanzania. They went to Airtel Money, which has some 3.5 million customers, and they said they wish to lend to the Airtel base. The offer was they would provide the balance sheet, they would provide all the scoring, they would take all the risk. They would share some of the lending margin with the telco if the telco would let them, and would do the collections, allow collections to take place via the Airtel Money account. Airtel agreed to it, subject to them granting every single. Airtel's only concern was their brand, and they wanted every client who applied for a loan to be credit approved. So Jumo did something quite interesting. They turned around and they said, right, we will grant a loan of 30 US cents to everybody who wants one. 30 US cents is the amount of the cheapest prepaid recharge on the Airtel network in Tanzania. So they effectively, in one night, they offered 3.5 million people a 30 US cent loan. Many people took it up. A vast majority of the client base took it up. But before I go through that, I want to just unpack what the product was. The product itself was a 15-day bullet loan, 30 US cents, 50% interest payable in 15 days. So pay us back in 15 days, 45 US cents. And that was the value proposition. And it was offered as an instant loan. All you have to do is say yes. The vast majority, and unfortunately I don't know exactly how many of the clients took it. Of those who took it, 95% paid back within the 15 days at the 50% margin. The 5% that did not were easily funded out of the lending margin made on the 95 who did pay back. And very importantly in all of this, for 30 US cents, you cannot buy data that will tell you that a customer will renege on a 30-cent loan. So in some ways, it is cheaper to simply grant them the loan, have them renege, and maintain good records of who you will never do business with again. This type of lending, although a 30-cent loan may seem... Sorry, I want to deal with one more thing before I move on to that. It is only feasible to grant, disburse, and collect a 30-cent loan if everything you do is digital. There is no way that a normal MFI could carry the cost associated with gathering all the documentation, approving, disbursing, and then collecting a 30-cent loan without making a loss. However, if you're doing it all electronically, your costs are virtually nil, and therefore you can afford to disburse and collect very, very small loans. Okay. Cost containment. We did a lot of work while I was at the IFC on exactly what it costs to go digital as opposed to running traditional businesses. And what you see here is an analysis we did of MFIs using digital as a cash in, cash out capability as opposed to using their own branches. M-Pesa is used as the Kenyan operation is used by many MFIs within Kenya as their cash in, cash out point. They charge a fixed fee of 24 cents US to the agent, to the MFI to use them. We went to 4 MFIs and asked them to estimate what it costs them to operate their branches per transaction. Now, activity-based costing is what activity-based costing is, and so obviously we got a fairly broad response in terms of what people believe it costs them to operate their branches. One MFI believed that it costs them $2.24 to touch a customer, to either accept a payment or to do a disbursement. Another one estimated at $6. If you look at the electronic channels, the most important message of the slide is if you compare the cost of a branch to the associated costs of running electronic channels and digital channels instead, you will see that it is significantly cheaper to either use an agent network or an ATM network as your cash management of the clients. As I said earlier, okay, the figures that you see in front of you now are only for the branch, the final customer front end portion. If you add in the back office, you add in all the back end processes, that's how you get to the number I said earlier, which is effectively that you can save approximately 85% of your transaction management costs by going fully end-to-end digital. An important aspect, the most important aspect of this slide, which I would like you guys to take away, is not so much the absolute values, but the trends. Note very carefully that the more your transaction volumes rise, the more your transaction costs drop. And this is a core difference between digital and your traditional financial services structures and branch structures. The good thing about branch infrastructure is that you invest in the infrastructure as you need it. So therefore, your costs roughly scale with your volumes. Digital, on the other hand, is an upfront capital expenditure, which you then have to amortize over the number of transactions that you get. So key in any digital project that we do is to ensure that one gets sufficient volume to carry the capital investment that's required to get into digital. But if you climb over the hurdle and you're able to achieve the volumes, then it becomes pretty much a no-brainer after that from an economics point of view. Customer services. The IFC also looked at the impact of digital on customer services, and some of the MFIs that we spoke to had actually gotten to the point where they'd given their loan officers iPads and allowed them to go and visit the clients, and they would take photographs of the liened assets. They would take photographs of the family, photographs of the houses. They would fill in the form online, and that would allow them to remit the loan application information back to the head office, and therefore to the credit committee, in about 20 to 25 minutes. That allowed some of the MFIs to move from a 1 week or 7 day, 5 to 7 day turnaround time on a loan application to a 2-day loan application. Now, if you compare that to Jumo and the likes who are doing it in a matter of seconds, there's still some way to go. But the point is that to cut to a third, your processing time is already a giant step in the right direction. The market is going to want to move towards instant credit issuing over time, but certainly these guys have already achieved a significant step in that direction. Some remarks that were made by some of the loan officers: the 80% decrease in the time required for clients to fill out forms, no waiting, while forms get carried around, and unfortunately some forms got lost. So basically the customer experience of working digitally was substantially better. If one takes a school view of this and says, well, how might this help the education sector? A very interesting pilot was conducted in Liberia by USAID and M-Star is a mobile network operator in Liberia in Africa. The problem that they were seeking to resolve was that the average teachers were paid with checks, and they had to take these checks to a bank, and they had to cash these checks to actually receive the money that they were being paid. Bearing in mind, again, that Africa has a strong tendency towards being a cash-dominated economy, they needed to cash the checks in some form. 75% of teachers that they surveyed indicated that they lost 2 days of school or more required to go and fetch the check and cash it and then meet their commitments. The other 22% or 22% indicated that they were out for somewhere between a day and a week. That's a substantial loss of productivity within the schools, and it's very disruptive for education. Because of that, that led to, when the pilot was announced, to use mobile money as a salary distribution mechanism instead of the checks, 89% of the respondents jumped at the opportunity to go in and use mobile money. Before the mobile money was launched, 71% of teachers took their salary once a month, and 21% decided, because of the disruption, they would do it every other month. Now imagine the cash flow implications for a teacher to only be paid every 2 months. It's not ideal, but bearing in mind below that it was costing the teachers something like 15% of their salary to go and collect their salary, you can understand why they would want to do it. Moving from checks and cash to mobile money cut the number of hours saved per teacher from 13 hours of active working on collecting her pay down to 25 minutes. It also had a significant direct cash savings. The cost of cashing salary checks to the teacher was in the range of $25, made up of transportation, bank charges, food, lodging, adding up to a total of around $25, when that got dropped to $2 in transaction fees at the agents near them, which effectively are shops. So they were rotating the cash in local shops to pay the teachers their salaries. There's an example of how digital can improve convenience in the customer's life quite substantially. So we have a poll now, which I'd like to calling Alkis to administer with you guys.
Thank you, Andrew. So the first poll for today, we want to know which strategy do you think would best fit your organization. So you will see tab in your computers right now. So please select one of the answers: expansion, cost containment, customer service, defensive, or not sure, not applicable for your organization. We will keep the polls open for around 50 seconds, just so we get all of your opinions, and then we will discuss with Andrew the results of this poll. So which strategy do you think would best fit your organization? We'll keep them open another 20 seconds. And we are gonna await the results soon. Okay, we have very mixed results, Andrew. So 20% expansion, 25% cost containment, 35% customer service, 15% defensive, and 5% not sure. Andrew, I'll leave it up to you if you have any comments on these results.
It reflects the group. I guess is the easy way out. I often found that expansion is the trend. However, I think it very much depends where people's businesses are as to what's going to drive them. Cost containment is a very tempting offer, especially as it gives you the flexibility to decide whether you want to become price aggressive in your market. And customer care, of course, is also important for most organizations. So yes, I mean, I'm not surprised. It's an interesting mix, but yeah, it's not surprised. All right. Any other comments, queries on the poll? Can we move on?
Yeah, sure. Just move on. Thank you.
Right. Operating models and partnerships. If one were to get into digital, what would you need to do it? What we've tried on this slide to do is to capture absolutely all of the ingredients required for a successful operation. In the purple box on the outside, down the left-hand side there, the virtual branch strategies, the brand, the value proposition, competitive positioning and products, i.e. the strategy of your business, is what's in the purple box. The decision to do it is one side. Then, having decided what you're going to do, you need the ability to serve and to deliver the service to your client. And that I've split into two sections again. In the orangish box, the systems, the back office, and the call center, those are items which effectively you will need, and you can very often outsource. There are many organizations out there who would be willing to provide you access to their systems on a per-click basis or on a cost share basis or revenue share basis of some sort. Back offices, you can often rent access to a back office as well, same thing on a click fee basis, and the call centers. Agent administration, I've separated out because it is a fairly substantial piece all by itself. Getting non-bank infrastructure to behave like a bank infrastructure and protect your brand and serve your customers the way you want them to be served is a mixture of a science and an art, and it requires that you are that you are permanently managing your agent network very carefully to make sure there's enough liquidity, to make sure they adhere to the processes which will not expose you to any risks, and that they are portraying your brand the way you would like your customers to experience your brand. The portions in the orange box and the brown box, i.e. the ability to serve side of the slide, are already available from many other organizations. And the question that anybody implementing digital then needs to ask themselves is, do I buy some of this for myself and build it for myself? Do I rent it? Or do I partner to gain access to it with an organization that possibly has some of it already, and sharing would therefore make sense in some way, shape, or form? looking at partnering, there are numerous ways in which organizations have partnered together to make this work. The purple box, and if you, just for this slide, the orange block is a financial institution. By that I mean an entity that has a license to conduct financial transactions on behalf of clients and or hold and intermediate customer money. Non-banking partner could be anything. It could be a telco, it could be a retail outlet, it could be a automotive outlet if we're talking about automotive loans, depending on it's a non-banking entity which has access to customers in a specific segment of the market that you're interested in serving. We've seen non-banking partners and financial institutions come together in joint ventures where they effectively form a subsidiary under themselves, the top left block there. An example of this is a Claro and Bradesco in Brazil, effectively formed a joint venture company which enables Bradesco to sell financial services to Claro, which is a telco's customer base, through a Claro mobile money operation, but it's jointly held and the profits are split between the entities based upon the performance of the subsidiary. In the top right, another way in which we could execute a partnership would be for the non-banking partner to effectively perform all of the non-regulated roles of digital financial services, leveraging the license of a financial institution. The classic example is M-Pesa. Corporate Bank of Africa's license is the license which holds the float, and it is the bank of last resort for the M-Pesa customer base. But the truth of the matter is that the real work, the real day-to-day operations are conducted by Safaricom, which is a non-banking entity. Bottom left, this one is particularly relevant in Pakistan, where the regulator said that all digital financial services will be conducted by licensed entities, and those licensed entities will be regulated by the central bank. So the response was in Pakistan that all the mobile network operators either started the greenfield or bought existing microfinance banks, and they took those subsidiaries and from a compliance point of view, when they wished to launch their service, and the central bank said, well, which bank would like to launch the service, they would point at their own subsidiary. But if you look at it from an operational control point of view, the non-banking partner exerts via the board complete control over those microfinance banks, and therefore effectively has captured the license for the purposes of running their digital financial services play. The last one would be where the financial institution performs all of the digital work itself, but uses the distribution capacity of a non-banking partner. Again, in Pakistan, MCB and HBL have gone this route with their digital offerings, and they're effectively they've got agent aggregators who run the agency networks for them on a fee basis, but the actual financial work, the banking is done by the banks themselves within their own operations. Choosing a structure and choosing a partner is always going to be about balancing what you want and what you can get. So if you look at the motivations for a non-banking partner to get into digital financial services and what they can give and what they will expect in return, from a contribution point of view, the non-banking partners typically have a customer base. And back to my opening statement in this section, if you're wanting to sell motor loans, to go and do a deal with the local Toyota dealership makes a lot of sense, because all the customers that are in there want to buy cars, ergo probably need motor financing. So the non-banking partner can contribute a customer base. They have a brand which is relevant to that customer base. Back to the Toyota example, they have market reach in the segment that you're talking about. They have a retail mindset. They're product movers, not financial wizards. So most often when deals are done between financial institutions and non-financial institutions, the nuts and bolts of the financial product are left to the financial services partner to do, while they are delivered to the market en masse by the non-banking partner. What would they want in exchange? Well, additional revenue is a big one, and they don't typically just want transaction fees. They now want to be part of the revenue cycle of the customer, which of course is a cause for a lot of debate when setting up these partnership agreements. They're also looking for customer lockdown, which they can achieve via enriching the relationship with their customers, as well as access to funds for other offerings. This number 4 under the value expected is more specifically relevant to telcos who have a strategy of effectively seeking to be the electronic portal for their clients. And in delivering other digital content, they need access to cash, which doesn't come via their billing infrastructure, because the cost of funds in traditional telco billing is too high. So they'll be looking at cash in an account, which can be used to buy things like Coke at a vending machine, Coca-Cola at a vending machine, which has a known market value, and therefore the cost of funds to fund that transaction needs to be relatively low. The bank, what can they contribute? Well, of course, they're regulated, and they have regulatory compliance, and they have a license to hold funds and or intermediate funds. Their bank brands tend to be trusted, but not necessarily aspirational. Many retail brands and consumer-orientated brands tend to be pretty funky and attractive, but not necessarily trusted. So when we bring those two brands together, we get aspiration and trust together. You get the maximum penetration of the market, because you're touching two aspects of the client. You're ticking the box for trust, but you're making it something the client wants. Risk management and branches certainly are in the bank's alignment. Value extracted, there's more customers to serve. Perhaps the best way to talk about these deals. One of the clients that I consulted to, the CEO, we were there to help them to structure a deal between a bank and a telco. And the CEO of the bank called me into his office and said, "Look, tell me what this deal is really about." And the deal with him at that stage was really about getting access to customers that they do not serve. So I said to him, the deal is pretty much, you're going to share the revenue that you can make on customers that you currently cannot reach. Because the country under consideration, a very large proportion of the population was rural. It was not cost effective for the bank to build infrastructure in the rural environment, because the population is sparsely distributed. However, the telco had a very significant footprint in the retail environment, in the rural environment. Therefore, by coming together, the two were able to serve a market which neither of them could serve on alone. The flip side of it is that the bank was being asked to do something which in its own mind was an anathema, which was giving away some of a share of the lifetime revenue of the customer. However, if they didn't do the deal, they couldn't serve the customer. So it's those kinds of deals that we're talking about to get to build structures between the two entities. The choice between these pictures is all to do with that line at the bottom, finding a management structure which allows both entities to become comfortable that they will get what they want in the long term. Now, some of the structures on the previous page, some of them lend themselves better to long-term profit sharing, etc., than others. And yeah, it's a matter, in doing the deals, it's always important to bear in mind that a lot changes over a 5-year life cycle of a relationship between two entities. Of course, partnership is not the only way to do this. Many banks have decided to go it alone. They've done some fantastic work. Thinking off the top of my head, Odea Bank in Turkey have done an absolutely phenomenal launch of a digital bank. It went from bank 40 out of 40 to bank 13 out of 40 in 24 months. Entirely digital, all by themselves, no telco. But those kinds of launches require a very substantial investment, simply because you're no longer leveraging any assets that are out there in the market already. You are effectively yourself recapitalizing the whole go-to-market model. And so The upside is control, the downside is financial risk to the entity if you don't want to partner. And for a poll on partnerships, I'll hand over to Elke. Elke? Uh-oh. David, are you able to run the poll? Okay, it looks like there's nobody in Chicago who can run this poll for us.
Andrew, I think Elke might just be muted. So actually, due to the tightness of the schedule, we're running out of time here. So I think what we'd like to do is just to skip to the final poll and pick up where we left off next month. If that's okay for you.
That's fine. So you want to go to the last poll?
Yes. So we'll just skip ahead to the final poll, which is having seen the presentation thus far and all the great material that we've covered this month, is digital something that you are considering as an institution? And the options are yes, we are already doing it and it's going well. Yes, we are doing it but would like some help to improve. Yes, we are interested and would like some assistance. And no, it is not a current priority for us. Actually, did I read one of those wrong? No, that's correct. And we will just leave this open for another 20 seconds or so before we go into the Q&A section of the presentation. Okay, so we've got responses coming in, and it looks like we're split between two options with a little jump there. So let me go ahead and close the poll and share the results. 8% are already doing digital as an institution, and it's going so smoothly they don't need any help. 62%, the vast majority, are already doing it but would like some help to improve their business, and 31% are interested and would like some assistance in implementing digital. So we'll turn that back over to you, Andrew, to reply to, and then we will open it up to attendees to use up our remaining time with the Q&A.
Okay. It's very encouraging to see that as many as 8% are in and running. Digital is a great product, and for those who are running well, I'm sure you're really enjoying it. Yes, for the others who are looking at or already doing it, we would like some help, and for those who are interested, certainly it's something that we at CapPlus would be very interested in discussing with you. I believe we can bring you a lot of help, a lot of assistance from well, basically experience of what we've done around the world, and yeah, we could most certainly help you. I guess it's going to be to Ellen and the team to discuss with people individually what they would like to do. I'm very glad that nobody voted no. It's not a priority for us, I must say. Right, Q&A. How do we go about this?
So we just have 4 minutes left, and we want all our attendees, if they have any questions, to please feel free to write them, so we can at least tackle some of them for the remaining minutes that we have. The first question that we have received, oops, there is 1 second, sorry. Okay, the first question that we have received is, if you want to start a DFS from scratch, what would be the first step and how long would that take?
Okay. I'm actually going to hop back. I had a slide on that, and I'll walk you through the slide in answer to that question, if you're comfortable with that.
Sure.
There. Okay. If you assume a greenfield project, i.e., it's a financial institution with a license, but they've done nothing in digital and they want to move ahead, we see this as the total process to go live. We run out our designs off feasibility. My belief in building any business, you have to have a target market segment with a segmental commercial banking problem that you're going to solve. So it's a target market with a defined problem, a product that addresses the defined problem, a delivery channel that will deliver the product to the people that we're targeting. We roll all of that together and we actually build a financial model of whether or not it's feasible. So we do a full project feasibility from choose the correct target segment, choose a product for that segment, choose a channel to deliver to that segment, choose a rough technology platform, at least a broad view of what would be required to service that market, introduce all of the costs, all of the capital commitments, and the revenue that we could potentially get from the market, and we drive that revenue in an ideal world of a primary market research, so that we can be grounded in reality of what the market really thinks of the product. We generate a 60-month cash flow analysis of the project. If we were to do this project, it would call for funding of this much, it would generate revenue of that much, therefore the project itself is worth this much to our organization. We view it as a standalone project. Of course, it leverages existing staff. The way that is imputed into the model is that those are brought in for free, if you like, because they're absorbed elsewhere, or we explicitly account for them depending on the preferences of the finance department of the client that we're working with. We then put the CEO and the senior management in a position to go to their board with a very tangible, this is what it's going to take to do it. For us to do that work takes 2 to 3 months, but what it does, as I say, it puts you in a position as the client to know what you're in for, in terms of peak funding and in terms of profitability going forward. I hope that answers the question.
Great, thank you, Andrew. So we have time to take one more question, and that's going to be the last one, unfortunately. But what's the biggest mistake or error FIs commonly make in embarking on DFS projects?
The biggest mistake I've ever seen them make is Me Too products. Shortly after M-Pesa launched, every single telco started launching remittance products. And I'll give you a perfect example of where it didn't work. Ghana also has a very, very migrant labor force. But the key difference between Ghana and Kenya is that in Kenya, the migrant labor force take their families with them. So they're remitting to their parents, where in Ghana they don't. So the demand for remittance services back to the core family was completely different. And the product needed to be completely re-engineered for Ghana to be commercially viable. The initial launch of remittances in Ghana was not 100% successful, simply because it was a Me Too product and it wasn't tailored to the needs of the market. That's probably the biggest single risk that is taken by a mistake made by FI, is believing that you can launch a one-size-fits-all to the whole market and it will just fly because it flew somewhere else.
Great. Thank you very much, Andrew, for tackling these two questions. Unfortunately, we are under some time limits and time constraints, so you can email us any other questions that you might have, and the ones that we have already received, we're going to tackle them through our LinkedIn profile. Thank you to everyone for joining us to this webinar. As I said before, this is only the first webinar on DFS. We'll have Andrew again next month, so you can always come back next month and for the second series of the DFS webinar.